This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's episode of the AJ Bell Money and Markets podcast. I'm Danni Hewson, and this week Charlene Young is in the hot seat with me. Hi, Charlene.
Hi, Danni. It's been another crazy week dominated by elections. We'll get to that in a second. But also in market news, the Fed delivered a boost with comments that set expectation racing that a rate cut could be on its way as soon as September in the US.
We will look at results from Tesla, which weren't as bad as had been expected, Sainsbury's, which was troubled by its Argos operation, and Tom and Steve from Shares Magazine will be here to do a deep dive into the sportswear giant Nike.
Plus some key market trends from the first half of the year, latest figures from the Bank of England that show ISA subscriptions continue to break records, but mortgage approvals are flatlining. And we've got the latest house prices, which show some subdued resilience as mortgage costs continue to hold back activity slightly.
Hi, and welcome to this special segment of the podcast. So, joining me today is Dan Coatsworth, and I am Laura Suter. We are recording this segment just as the results are coming in of the general election. We wanted to take a break from the normal podcast proceedings for a moment just to update you on those election results, how markets have reacted to them crucially, and anything that investors need to bear in mind following the general election. So, hi Dan, good morning.
Morning.
Have you been up all night waiting for the results to come in, or did you sensibly go to bed early?
Well, I tried to go to bed early, but I couldn't sleep, so I did keep looking at my phone all the time, and then, of course, wake up early this morning looking at it again. But yeah, I think everyone was curious to know what we all kind of know. We kind of knew, didn't we, what was going to happen? But it's still that. Oh, I wonder if what might happen. You know, is there any changes? But yeah, it's all done and dusted, isn't it? I'm sure everyone's everyone's got their own views on whether it's the outcome. But in terms of from an investment perspective, we've got some really interesting things to quickly discuss before you hear the rest of the podcast.
Exactly. And as Dan touched on there, we're going to leave the politics to one side. There will be no views from us on the outcome, whether it's positive or negative. But as we're sitting here, the results are still coming in, but we know that Labour have won by a landslide. And I'm sure people don't need me to talk through the actual election results. But what we thought would be interesting to touch on was the market reaction, albeit not huge, and some of the things that investors kind of need to look out for. So, Dan, I think we talked in previous weeks about how markets were pricing in this Labour win. And so you would expect that there wouldn't be this huge dramatic market reaction considering the result has gone the way that most forecasters expected. So what have we seen from markets today? And I think it's probably worthwhile caveating this, that we're recording this on the morning of the results. The results are still coming in, and so markets are going to continue to move throughout the day. But the snapshot that we're seeing it in the small amount of time that markets have been open, what are we seeing?
Yeah, I mean, to be honest, they've reacted better than I thought they would. Everyone had sort of the consensus of the market, I should say, was that Labour would get in. Therefore, when you have that result, you'd think that the market would do nothing. Gilt yields did nothing, which is kind of as expected. The pound moved up slightly, but that's down to the dollar being depressed. So because of recent economic data in the US points to potential interest rate cuts a bit earlier than expected over there. But so that just means that we kind of need to judge it by the equity market. So the FTSE 250 index is the one to look at. That has a higher weighting to UK companies in it than the FTSE 100. So it's a better sort of bellwether of what's going on with the economy and politics and stuff. So that in just about the first 50 minutes of trading on Friday, it was up 1.8%. Just to put that in context, if you're not quite sure about whether that's a good or bad thing, I always took the view that if a stock market moves by more than 1% in a day, If it's up, it's a brilliant day. If it's more than 1% down, it's a very bad day. So 1.8% is really good. Now, what's driving it here is quite surprising. It's house builders doing particularly well. Now, we all knew that Labour was very sort of pro-housing. So if you had to draw up a list of winners and losers ahead of the election result, up there would be construction companies, house builders, building materials companies, because they're all ones that would benefit from Labour's policy to essentially build more houses. Let's look at different things like disused car parks, wastelands, try and get some more building on there. So I am quite amazed that the market is sort of focused on them again and bid them up. But come 9 o'clock, we then saw the market slightly give up some of those gains. So, obviously, by the time you listen to this podcast, who knows where it's gone? But the initial start was very good. And that just suggests to me that we've had a long period of political uncertainty. Now we've got Labour in number 10. I think that investors are feeling a bit more confident about sort of the political backdrop for the UK. Now, if you add that on with the existing takeover activity, I get the impression that people are starting to be a bit more interested in the UK stock market because one by one, some of those key risks have been taken away. Of course, Labour wants to do more with the EU. We could see sort of more trade deals, more collaboration. So I think all the nervousness that happened around UK stocks after the Brexit vote. Not saying that Labour are going to go towards and try and unwind Brexit, but just a bit more collaboration. Again, it's another sort of positive for the UK market. And again, if you just look at Europe as a broader space, the German Chancellor is not very popular. France is going through its own political headaches. The UK actually looks a little bit more stable now. So all these things are sort of playing to the benefits of the UK stock market, hence why we've had this good reaction. So I think the way to judge it is let's look at the performance over months, not simply a first an hour and a bit. But so far so good. But let's see where it goes next.
And I think, of course, we know from very recent history that it's not just the election result or the vote result that matters. It's also when Labour unveil more of their plans, when they have their first budget or fiscal event, because, of course, we saw from the Liz Truss budget that had a dramatic impact on markets, obviously. Now, I'm not saying that we're expecting to go back there. I think politicians have learned the very harsh lesson from that. But I think in terms of market reaction, like you say, what markets are doing at the moment is digesting that initial news. But because Labour's manifesto wasn't super heavy on policy, on announcements, markets will then react to what they say over the coming days, weeks and months when it comes to things like how they're going to boost the economy, any changes that they may be making to taxes, any spending plans that they do unveil. Obviously, the pound and also markets will react as that comes along, and obviously we will keep you up to date on that. But Dan, I know you've been digging into some of the data in terms of how markets generally have reacted to different general elections. And how does this one, in its initial kind of hour or so, shape up with previous ones?
Yeah, I mean, because I did some digging yesterday, thinking, I'd just be quite curious to know if you go back to when, say, the FTSE 250 was sort of first created. So you're essentially starting your analysis from when Tony Blair became Prime Minister in 1997. So I looked at each of the first days that we had a new Prime Minister in office. So if we go back to the 1.8% initial reaction today for Keir Starmer getting in, it's actually the second best one that we've seen in a while. So the best one was Rishi Sunak getting into power in 2022, 2.8. Yeah, so I mean, I think there is a reason for that one. There's 2.8% gain in the day, but I think you need to take a few step backs, because if you start with Boris Johnson, sort of the government, when he got in, the stock market barely moved, 0.2%. Now, I think after 3 years him in power, and obviously we had the horrible pandemic, I think people are just getting a bit frustrated by things. So when essentially Liz Truss came in September 22, people quite relieved, and so the market bounced by 1% on that day that she got in. But I think all of us will remember that she then came out a few weeks later with a very chaotic budget, and the markets went all over the place. So she didn't last very long. So when Rishi Sunak came in, it was more of a case of thank goodness that we found someone else who's deemed competent enough to run the country. So the 2.8% FTSE 250 jump on the day, I don't know that it was really a reflection of what Rishi Sunak was able to do. It's more of a case of, thank goodness that we've got a change in leadership, because the one that we just had for 5 or so weeks wasn't very good. But then, I guess the key thing to think about is that today we've got a shift from Conservative being in power for a very long time into Labour. So the last time that happened was when Tony Blair came in. When his first day, the market was down 0.1%, so barely any change. You're wondering why no change? It's because the stock market's forward-looking. The market is got a. If you go back to when Tony Blair came in, the market was going. The country just felt like he just needed to. It was going through change. He just wanted something different, complete different change of style. And so all that would have been priced in. So the fact, when he won, it was like, yeah, we were all expecting this. It's fine. So that's how actually I thought today was going to be. I thought it would be really flat, nothing going on much, because everyone kind of, just look at the polls leading up to the election result. It seemed pretty clear that Labour were going to have a landslide victory. Keir Starmer would come in. We already knew that he was going to benefit, his policies would benefit certain sectors. So the fact that it has jumped is a surprise. The fact that the obvious sector winners have also jumped again is a surprise. But I guess a key test is, can they hold on to these gains?
Definitely. And we will be keeping you updated. There's lots of things on the new Chancellor and the new Prime Minister's to-do list when it comes to finances and investing, from following through on some of their manifesto promises on things like the state pension triple lock, increasing minimum wage, things like that they kind of laid out the plans for, as well as those crucial plans on how they're going to boost UK growth, which was something that was talked a lot about during the campaign. We've got lots of articles on the AJ Bell website if you want a more in-depth look at some of the changes that might be coming for your personal finances, or some of the policy priorities when it comes to pensions and savings that Labour should and will be focusing on in the coming weeks. But back to the normal podcast now, which we recorded before the result of the general election, but is still jam-packed full of interesting and good stuff to listen to.
Right, market news. Now, remember, Danni and I are recording this bit on Thursday morning, but when it comes to markets, forget elections, Danni, because some old trends have been at play over the first half of this year.
Yeah, they really have. We've been looking at the first 6 months of 2024, but as you say, one of the key things which has been really dominating market expectation for not only the last 6 months, but also it feels like at least 18 months, is the expectation of a rate cut. When will central banks start cutting interest rates? Obviously, we know that the European Central Bank has already made the first cut. But the big one, of course, in terms of global markets is the United States Federal Reserve. And as we speak today, the CME FedWatch tool have a 74% chance of a September rate cut and 2 interest rate cuts from the Federal Reserve this year. Now, that follows Jerome Powell's comments about inflation. He said a couple of days ago that the US is seeing a lot of progress. Obviously, we still have to sort of wait for all of that to bed in, but it sent pulses racing. Investors, they were burned at the beginning of the year. Huge expectations that rate cuts would start at the beginning of the year. Then inflation proved more sticky than I think a lot of people were expecting in the United States, and that expectation was kicked into the long grass somewhat. But as investors once again start pricing in rate cuts, it has seen equity markets absolutely soar. So it pushed the S&P 500 above the 5,500 at close for the first time ever on Tuesday. The Nasdaq also closed at a record high on Tuesday. And Thursday morning, as we're recording in this, now bear in mind that US markets closed early yesterday and they will stay closed for the 4th of July holiday. But Asian markets have soared. Japan, Taiwan hitting fresh records. European markets also up today, including the FTSE 100. I don't want to say too much about UK markets here because I'm sure in the nature of podcasts that Dan and I have just been discussing post-election performance. But I will say that looking at rate cut expectation for the Bank of England, that's now standing at 55%, expecting the first cut in August. Now, we know the MPC is its own beast, but Andrew Bailey won't want to get too far ahead of the Fed because rate cuts impact currency, and a weak pound against a strong dollar could negatively impact the inflation story. Politics will continue to impact markets, not just here in the UK, but also in France, where investors are nervously waiting for the outcome of Sunday's second round. And of course, in the US, where Joe Biden has to make a strong showing over the next week if he's going to fend off calls from his own party for him to step aside for a younger model to take on Donald Trump in November. But rate expectation, once again, a key theme. Looking at the key metrics for the FTSE 100, it's returned 5.6% the first half of the year. Doing the same again, the second half would be a reasonable year for UK stocks, but eclipsed once again by US indices. North America, we've seen gains in the region of 14 to 18% from US indices. It's no wonder investors are really focusing there at the moment to build wealth. And of course, a lot of the success for US indices is related to those huge tech stocks and that love affair that AI really has kindled amongst investors looks set to stay a key theme as we enter the second half of the year. I was just talking about Asian stocks. Well, Taiwan markets have been the most successful Asian market so far in 2024. And that is primarily because of the performance of Foxconn, which trades as Hon-Hai Precision Industry, and Taiwan Semiconductor Manufacturing Co., up 97% and 80% respectively since the start of the year. But put in context, NVIDIA up 166% since the start of 2024. Now, you would think, Charlene, wouldn't you, that NVIDIA would be the overall best performer? I mean, that's the stock we've been talking about.
It's not the podcast if we don't mention NVIDIA.
It's really not. But I think a lot of investors will be surprised that for the first half of the year in the United States, it wasn't the overall best performer. The top slot went to Super Microcomputer. Now, again, it's another AI darling. It designs and builds servers and storers, and it has significantly beaten market expectation when it comes to quarterly earnings. And this craze just doesn't look like dying off. There's been a lot of talk about whether it's sort of, another dot-com bubble, but we know that a lot of companies are looking to AI to power productivity. It's one of the areas that they are really wanting to continue to spend in. So certainly at the moment, we haven't seen any disappointments from the likes of NVIDIA or Supermicro. And just ending on the last theme, which really has dominated UK markets over the first 6 months of the year, takeover of UK companies. And 4 of the 10 best performing stocks in the FTSE 100 during the first half of 2024 were propelled by takeover activity, including Darktrace and DS Smith. Again, it's all about the same thing. Lots of stocks trading on cheaper or depressed valuations relative to peers in other parts of the world. And then bargain hunters are looking to snap them up.
Thanks, Danni. So we're going to stick with trends for a second, but drill down to some company news. And Trends in electric vehicle demands have been slowing. Now, something I'm interested in as an electric vehicle driver myself. Is this still the case? Is it still slowing?
Yeah, despite industry concerns that demand for electric vehicles, particularly in the US and the UK in recent months, has been weaker than anticipated. Actually, globally, the sector is still growing. And looking at a recent outlook from the International Energy Agency, it was saying that more than 1 in 5 cars sold this year around the world are expected to be electric, including nearly half in China, which is significant proportion. So even though we're sort of saying, look, cost of living crisis has impacted people's ability to buy electric, maybe those that wanted or are able to go electric because of their lifestyle have already done that, or their finances, and that car makers need to really double down on trying to make more affordable EVs. It does seem certainly that in parts of the world like China, like India, there is a huge opportunity. Now, Tesla really was the first player, wasn't it? I mean, it was in the driving seat. But what's been fascinating is that it has seen a significant sales slump. And for the first time in the company's history, it saw sales fall for 2 straight quarters. Now, despite the fact that there was huge disappointment from Tesla with sales down nearly 5% from the same period in 2023, that's in the second quarter of the year, it wasn't as bad as investors had been expecting. Now, Tesla's got a lot of issues to deal with, not least, of course, its leader, Elon Musk, who really does sort of split the field when it comes to sentiment, either consumer sentiment or investor sentiment. But we know that Tesla has had issues with refreshing its lineup, and that is something that a lot of analysts have really been looking at. We know it's launched Cybertruck, that has had some issues, but what it did do is it managed to pull back the title of the lead in global sales of purely electric vehicles last quarter from Chinese automaker BYD. Now, BYD is still going great guns. A lot of competition now in the sector, a lot of pressure on some of the sort of legacy automakers really to find ways to cut costs, maybe to sign up with other players in order to take advantage of technology or to take advantage of the ability to make EVs more cheaply. But it is interesting that despite the fact we are talking about range anxiety, the need to spend more on infrastructure, and concern about how the cost of living crisis has impacted consumers, it is still a market which is growing and looks set to grow further. But in terms of Tesla shares as well, really interesting because it has managed to pare back almost all the losses that it's seen from its share price since the start of the year.
Thanks, Danni. So, going to move a bit closer to home and talk about Sainsbury's because its results have actually disappointed investors.
Yeah, it's doing great guns when it comes to food, which is where it's really been sort of focusing a lot of its time and energy, trying to make sure that it offers reasonably priced food, that it price matches those discounters. And of course, that's where people have had to focus their resources on things that they have to buy rather than, those nice to have. So any disposable income has sort of gone there. Whereas, particularly for big ticket items, electronics, that kind of thing, people have been putting those purchases on hold. And that is where Sainsbury's has come a bit unstuck because, of course, within a lot of those Sainsbury's stores now, you've got those little Argos stores. Have you ever been and visited an Argos store in a Sainsbury's?
Yeah, I go quite a lot. My kids are quite young and we're in the midst of lots of different parties, birthday parties. So I actually find it really, really useful for gifts because you can just go and pick it up and they often have a few deals on, but I don't know, maybe I'm the one propping it up here.
Well, the 3 for 2 deals was certainly something I used to use an awful lot around Christmas time for the kids. In fact, I one of my friends told me a neat little trick, which is that she would buy 3 for 2 of stuff and she would keep 2 of the things for her kids and then she'd sell off the thing that she'd got free in order to sort of boost her budget for Christmas gifts for her
Right.
kids, which I thought was very smart. And I certainly gave it a go for a couple of years. But the thing with Argos is that, we've seen the rain fall down. And let's be honest, when it's chucking it down, you don't want to spend money on things like garden furniture. And that is exactly what has impacted sales for Argos. There's been a lot of discussion about exactly how much of an albatross Argos is around the neck of Sainsbury's. And the Sainsbury's boss, Simon Roberts, actually did come out and say that customers are continuing to be cautious and that until we see sequential interest rate cuts, hopefully as soon as possible, he says, then the caution from consumers is going to continue on those more discretionary items. So, Sainsbury's, doing great guns in terms of food, not so good in terms of everything else, including clothing. And that is something which did disappoint investors when they announced those results, although what they have said is that the hope is that as interest rates start to come down, we will start to turn a corner.
Thanks, Danni. Now, I've got lots and lots of personal finance news to cover off in a second, but it probably makes sense if we stick with company news for now. And to that end, Tom Sieber and Ian Conway from our very own Shares magazine have joined us to take a look at US sportswear giant Nike, where the shares took a big stumble on their latest earnings report. How is it going to go about fixing its problems?
So, Tom, today we're talking about US sportswear and footwear maker Nike, which has had a bit of a reversal of fortunes in recent years, and particularly in the last couple of weeks.
Yes, exactly, Ian. Yeah, I mean, as you say, sort of Nike had a good recovery from the pandemic initially, and that was reflected in its share price. But subsequently, it's found life, a fair bit more tough going, and that's really come to a head with its latest quarterly update. The statement itself, if you just kind of looked at the headlines, wasn't too bad. They actually came in ahead of expectations in terms of earnings for that period. But revenue was a touch below expectations. And what was really key was the outlook was very gloomy, and they really downgraded their expectations for the current financial year. And I think particularly if you look at what lay that negativity, it just reinforced a lot of the market's existing concerns about the stock. Apart from the fact that I guess because of cost of living pressures, consumers have less capacity and willingness to spend hundreds of pounds on a new pair of trainers. So China, which has been a key market for Nike over the last decade, is continuing to struggle. And the company has found life fairly tricky here ever since it, along with several other Western brands, a few years ago, expressed concern about the use of forced labor in the cotton industry in the Xinjiang region, which I'm probably butchering the pronunciation of. But this led to a boycott amongst some Chinese consumers, and there are signs that Chinese domestic rivals have eaten some of Nike's lunch in the interim. It's not just China, though. Nike's been finding life difficult in other markets too, and it looks like the company's sort of taken its eye off the ball. It's allowed specialist brands, names like Brooks and Hoka in areas like running to eat into its market share. It's put a lot of attention into its Jordan basketball shoe brand, and this has been growing fast. But it seems like this has been at the expense of product innovation elsewhere. Ian, I know you've got some stats on Nike's market share that perhaps would be instructive for people.
Yes, so its US market share has been sort of drifting down slowly, Tom, and it's down to about 35% now, according to global data in 2023. Meanwhile, You've got, as you say, smaller brands like Hoka, which is owned by Deckers, On, and some of the older, more established brands like Asics and New Balance. Together, they've now increased their share from 20% during the 2010 to 2020 period to more like 35% of the global market. So clearly, Nike is facing some pretty stiff headwinds in terms of competition. But do I gather they're talking about launching some cheaper shoes?
Yeah, absolutely. I mean, probably cheaper in inverted commas, depending on your perspective. But yes, they are talking about bringing out, models that are more like $100 than perhaps upwards of $150 that some of their kind of more popular lines go for. And maybe we'll circle back to that later when we talk about a big investor day they've got later this year, which could be significant. That's really interesting, that sort of stuff around market share. And I think historically it's often been seen that the sportswear market has been a bit of a duopoly, with Nike and Adidas really dominating. But I mean, both, we won't go into Adidas in too much detail, but both have had a harder time of late, and it's interesting to see those other brands coming through. I think another area where Nike has been struggling is with its direct-to-consumer digital-led strategy, which was a key component of its plans. And it was really predicated on the idea that Nike would then be able to keep more of the profit from its sales. But this strategy hasn't to date played out as planned, and they have done a bit of an about turn. It seems like people still want the choice that you get by going to a shop where you've got a range of brands. And basically that means that this is a really important sales channel which Nike has been neglecting, and it is scrambling at this point to bring wholesale partners back into the fold. And I mean, it's interesting, isn't it, Ian, given the CEO's background and perhaps why he was brought into the business. Maybe you could sort of talk a little bit about why he hasn't been able to achieve what he wanted to.
Yeah, that's a very interesting point, actually, Tom. Yeah, because Chief Executive John Donahoe is 4 years into his 5-year stint as Chief Exec. He was Chief Exec of eBay, and one of his main jobs was to strengthen the company's digital sales channels, and that just hasn't happened. Sales are flat in the full year to the end of May, and that's the slowest pace since 2010 if you exclude the pandemic. And one of his deals was to buy Converse. Well, that's been a disaster because their sales were down 18% in the year to May. So it's difficult to know really what the company's able to do to kind of turn the ship around. The finance director said next few quarters are going to be challenging, but they were repositioning the company to be more competitive. They'd have a more balanced portfolio, and that would drive sustainable, profitable, long-term growth. So the question is, are they just sort of kitchen sinking it with these forecasts? Could we be charitable and say, yeah, maybe they're aiming low so that they can beat forecasts from here on?
Yeah, I mean, it's a classic sort of playbook, isn't it? Although usually it's when a new management come in that they've got the kind of leeway to do that. Suppose they're putting themselves under pressure a little bit by kind of having such a downbeat assessment of their current situation. I think, we touched on it earlier, but this November Investor Day is going to be really significant. And I suppose it's worth talking a little bit about what investors might want to see at that Investor Day. It's already pulled the cost-cutting lever, which is, when a company is struggling, is often something they would do. It announced $2 billion worth of cost cuts when it unveiled a pre-Christmas warning. We talked about the plans to roll out cheaper trainers at around the $100 price point, which is more in line with the popular brands that rival Adidas, like Samba and Gazelle. They're more around that $100 mark. But they might need to do something a bit more dramatic. I
agree. I think innovation has been the big issue, and this is the big thing that analysts are pointing to, is you've got to innovate. It's they say, oh, they've refreshed the stores, but if you read research by analysts from Jefferies and other firms, they say when you go and check, it's just a lack of interesting new products coming to market.
Yeah, 100%. Yeah.
And
that's
as you said, they don't have that. They don't actually have those legacy, trendy things like the Sambas that Adidas have got.
No, it's a newer brand. I mean, it's still been around for a long time, but it's a newer brand than Adidas, so it perhaps can't reach into its archive, if you like, and pluck out those sort of heritage brands in the same way.
Yeah.
I mean, one option you mentioned, Converse, and the fact that that hasn't worked out particularly more recently. It has been, I suppose, before that, perhaps a useful source of diversification, but given it's struggling now, would they look at to sell that off? I don't know. That's a possibility, I suppose. I think you're right, though.
Yeah.
It's perhaps more fundamental around innovation.
I think they have to do something because I mean the shares are down 28%. They lost 20% on the day of that trading update.
Yeah.
And if you think down 20%, 28% this year, 30% over the last 12 months, the S&P is up 15% this year and 23% over the last 12 months. A big divergence. And the shares are almost back to $76. They're almost back to the low that they reached during the pandemic. They were $170, so they've derated hugely. So from my point of view, ironically, because I look at earnings haven't actually changed that much. It's sales, it's the top line that the market's really concerned about.
Yeah, absolutely. And I guess there's this sort of broader risk that, the athleisure trend, which became a big thing during the pandemic, people were essentially wearing the same gear for exercise, socializing, and relaxing at home, is starting to play itself out a bit. The woes of, and not to be too reductive, but yoga pant maker Lululemon hint at that as a possibility. So I suppose that's something that Nike might have to contend with too. But really, it's very, sometimes it's quite simple with a consumer facing or a retail business. It's really about having the right products, at the right price point that people want. And JD Sports knows what it's talking about. It's been a successful business, and the fact that its boss was sort of essentially saying Nike isn't producing the kind of stuff that people want to buy, and so that's what they need to fix. They need to have a better range of products, and I guess that's something that can only happen probably gradually, and it won't happen overnight. But if they can start to demonstrate that they're making inroads or progress on that front, that would be taken positively by the market. And it's worth saying it's still an outstanding brand. It's the swoosh motif is one of the most iconic in the world, but it does have a lot of work to do, doesn't it?
I mean, it has a phenomenal track record of growing earnings, I have to say. We can look at the data since the early 90s. It's grown its earnings at 12% a year, and with not much volatility. You mentioned Lululemon. It's interesting because, again, a lot of analysts, US analysts, do look at the two of them and they say, okay, typically you would expect Lulu to trade at a certain percentage of the value of Nike, in terms of market value. But Lululemon has actually grown. It's only been listed since 2007, but it finds itself in the same situation as Nike. Again, it's being accused of not innovating enough. It isn't appealing to the right customers anymore. The shares weren't as expensive as Nike, but they've derated. They've halved to just over 20 times. And this is for a business that has grown its earnings by about 30% a year. Again, the company talks about newness in its stores like Nike does, but you've really got to have something that draws the customers in. I know they've been appealing to a younger customer audience, but analysts say young teens, for example, they're much more fickle. They don't have the brand loyalty. So it seems to be a theme actually, Tom, across that athleisure space, if you like.
Absolutely.
I've got one final thing for you though from Lululemon. Apparently, Oasis Blue is the big color. So who knew? Fashion tips from shares.
Tom Sieber and Ian Conway from Shares Magazine. And if you're a fan of the podcast, but you've not found Shares Magazine yet, do look out for it. You can just Google Shares Magazine. All the daily news is free to access. And you can also find a link to subscribe to the weekly magazine. Now, Charlene, let's talk mortgages, because I touched on interest rate expectation earlier. Obviously, interest rates a huge issue for a lot of retailers, as Sainsbury's boss was saying a couple of days ago when it had its results out. But it's also, I think, fair to say that high rates are still having an impact on the housing market.
Yeah, they are. So mortgage approvals, so they've flatlined at around 60,000 a month for the last 4 months now. And now in May, with 800 fewer than we had in April this year. On the bright side, they are edging back to pre-pandemic levels. So that's in spite of the enormous jump in mortgage rates. So there is a little bit of light at the end of the tunnel. And on those rates and expectations, it feels like, you say, we've been waiting and waiting. And after seeing lenders put rates up, Santander are actually the latest lender to price in the expected fall in the base rate, joining NatWest, Virgin Money and Clydesdale Bank in reducing some of their fixed rate deals this week.
And in terms of house prices, they have actually been resilient, because I know a lot of people were worried that we would start to see, house prices really drop away because of the constraints on people being able to get mortgages, get on the mortgage ladder.
Yeah. So that hasn't sort of, in fact, played out. They have been resilient, and that rather kind of soggy election announcement didn't dampen anything either. So the average UK house price was up to £266,064, according to the Nationwide Building Society. And that was following modest growth for the month of June across the UK, albeit slightly lower than the rate in May. And I think it's kind of fair to say it's been a mixed bag in England. Prices have risen fastest in the North and the Midlands, but East Anglia and some areas in the south have actually seen falls over that period. Northern Ireland was the best performing part in the UK. So prices up 4.1% in the year to June. So I think we'll just wait and see whether that expectation of rate cuts and the kind of traditional post-election boost plays out over the rest of 2024.
Now, we've also had some figures showing that rents have hit record highs.
According to Rightmove, the average rent outside of London hit £1,316 a month in May, and that's 7% up on the same time last year. For those in London, the figure is actually double the rest of Britain, £2,652 a month, but up 4% over the same period, so a slightly lower rise there. And I think although we've seen record pounds and pence figures, the percentage year-on-year growth figures have actually cooled down slightly since the pandemic. So although the increases are far from stable when compared to pre-pandemic levels when they're around about 2% a year, that imbalance between tenant demand and rental supply is clearly on show still.
And I know that a lot of these figures have come with sort of big demands for the next government to do more, to create more homes, whether they be for rent or affordable homes to buy. And certainly in the last few days, we've seen house builder shares up. I know that there's going to be more discussion about the election, how markets react, and potential next week. So do stay tuned for that. Now, let's go back to those Bank of England figures that you were talking about earlier when you were talking about mortgages, because savvy savers are flocking to tax wrappers.
They are indeed. So £4.2 billion was paid into cash ISAs in May, according to those Bank of England stats, building on a record-breaking April, where it was 12.3 billion at that kind of start and end of ISA season. So it's really clear, the early bird savers want to make sure their cash is protected from tax, and they've really got that kind of ISA year off to a strong start. And why is that? Well, it's frozen tax thresholds coupled with previous rate rises, and it makes it more likely that savers are going to breach their tax-free savings allowance. So if you take a rate of, say, 5% on a savings account, a basic rate taxpayer with £20,000 in cash will start to pay tax over the course of a year on that interest, or for higher rate taxpayers, they would need just £10,000 in that cash account to be on the brink of paying tax on their cash interest. So what's the answer to that? We'll try and get it into a tax shelter where possible. So the personal savings allowance that I mentioned is £1,000 for basic rate taxpayers, £500 for those who pay tax at the higher rate, and a big fat zero, actually, if you're an additional rate taxpayer. So whatever your ISA flavour of choice, really, it makes sense with frozen allowances, rising wages to try and get as much of your savings or investments wrapped up away from tax as possible.
Now, one huge cost that's really impacted household budgets has been energy, but drum roll please, this week energy prices came down.
Yes. I mean, summer's not quite arrived, but that reduction in the energy price cap certainly has. So the updated cap came into force on Monday, and that means that people on standard variable tariffs would have seen their annual prices fall around 7%. So to avoid being charged any more than you should, it's a really good tip for anyone or those of us like myself without a smart meter to submit a reading. So it's not left up to your supplier to estimate what your energy use was up to the 1st of July and potentially charge you more. So although the change came in on Monday, as I said, so you might be thinking, well, why are you talking about taking a reading now? You can actually still send a reading in now and potentially benefit over the next couple of days, but try and do it as soon as possible.
And there is, unfortunately, a sting in the tail, Charlene, because it does look like the next price cap's going to go up just in time for winter.
Indeed. So the Cornwall Insights estimate has come in for the next cap to be actually 10% higher than it is today. So that new cap is going to be announced by Ofgem in August, and it would come into effect on the 1st of October. Now, of course, that's just an estimate, but a 10% jump just in time for autumn is not really what we all want to hear. And I think we've all probably been guilty of some kind of switching apathy. If it's not energy bills, it will be bank accounts or something else. And to be honest, it's probably made sense over the past couple of years just to sit it out on the cap if that's what you were on. But is it time now to make a fix or a switch or both? Like, Danni, what are your thoughts? What should people start weighing up? What is good value for them?
Yeah, it's funny, isn't it? Because up until we had the energy crisis, whenever we were talking about energy prices, we'd always say to people, look around, switch, fix, get the best deal. And then all of a sudden it was like, oh, first of all, there aren't really any opportunities to switch.
Yeah.
The fixes are not good deals at all, because the only thing that's going to happen with the price cap is, please, it's going to come down. But now we're in a really weird position. And for some people, it definitely makes sense to switch, to fix, to look around, have a good look around and see on some of the price comparison websites just to see where you stand. Now, I actually did fix just a couple of days ago, and I'm paying very, very slightly more than I would have been today on the cap that we are at the moment. But when the new cap comes in, as we expect it to be a bit higher, it would be less, and it just levels out for me. And I think for a lot of people, it's just knowing that they know exactly how much they're going to pay. Have you fixed? Have you thought about it?
I haven't fixed, but I am definitely going to think about it, because I do have, like I mentioned, the EV as well. So I've got my charger at home. And yeah, it's definitely something now that I'm starting to think about. And like you, I kind of value that little bit of certainty with my outgoings, that's for sure. So it just makes it a little bit easier to plan things. So I will be logging onto my app, not only to submit a meter reading, because I haven't practiced what I preached, but I will have a look and see what fixed deals are on offer there, and also a cheeky look at some comparisons as well.
I did. I was out there on the morning of the 1st, taking my photographs of my 2 meters, submitting my readings, making sure I wasn't going to be charged any more for my energy than I needed to be. But something happened to me a couple of weeks ago, which has just made me dance with delight. My energy provider sent me a letter, one of those where you think, oh, what's this going to be? It's got to be bad news. And it wasn't. It said, right, you're paying too much for your direct debit. We're bringing it down by 100 quid, and we're going to give you 100 quid back because you've too much in credit. That was exciting.
Oh, that's brilliant. Yeah, no, I mean, I'm always logging on to my apps to see if there's something to return, because I find that sometimes, they're quite happy to put the direct debit up, but when it can come down, it's a little more sticky than it should be. But I was just actually looking at my Hive app, and I can't believe it, but my heating has come on 3 times this week in the morning, only for a very, very short time. But downstairs, the temperature has certainly dipped, and the heating has snuck on for 40 or 50 minutes, which is just ridiculous and not very energy efficient.
That is outrageous. I'm a Yorkshire lass, so there is absolutely no way that my heating is going to come on in the summer. It's not happening.
I can't believe it. I mean, it's on the Hive, so it's on that little temperature check, but I am a southerner exiled in Cheshire, so not exactly the frozen north. But yeah, I better sort that out before my partner notices.
I'm going to be holding you to that, Charlene. That is all for this week's podcast. As I say, Laura and Tom Sieber are going to be on hand next week to really pick over the election result and mull over what it might mean for you and your money. We'll also have an interview with CVC on corporate lending.
Just before we go, I wanted to give a huge shout out to all of you who engaged with our Pensions Week special last week, either through this podcast or through the webinar, which had over 800 people actually tune in live and is available still to watch on repeat. We had loads of questions in, just showing how engaged people actually are with pensions, and there's a real thirst for information. And that makes me so happy as someone who sort of talks a lot about pensions and worries that everyone thinks that maybe they are a bit boring. So yeah, that was brilliant, and thank you so much. As I say, if you've missed the webinar, it's actually on the AJ Bell website. I should mention where you could actually find it. That would be helpful. And we've got lots of other recordings and investment videos in the shares and market section for you to dig into. So until next time, thanks so much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.